So one of the things that's frustrating about investing is control. You buy a stock, feel like you have no control over it. Okay, so we're going to be speaking, when we do cash flow, a lot about the idea of trying to bring as much control as possible to this. Now, in the first two things we've studied, technicals and fundamentals here, we don't get to control what that says. We cannot have a choice here. And so your 401k guy, that's kind of what he does. He hopes it's bullish. He hopes there's good news. He hopes charts go up. That's all he can do is hope, because he certainly has no control. It's like going to Vegas, betting on a horse or a dog. Okay, over here, this is where we can start having some choices, because while you can't choose what this stuff says, you can choose how you position yourself in cash flow and risk management. So I like the idea of having choice. So the beautiful good news that we have here for you and I, this is beautiful for you. I hate cliches like life-changing, but this really can be. You see, there are always huge opportunities for income, not small ones either. The potential in any market, up, down, or sideways, is absolutely beyond, it's almost beyond comprehension how much there is that we can do. The more I learn it, the more I act as a student with you, the more I'm amazed at the opportunity that's out there, which right now is good news, because you know what? In a bad economy, there's not always opportunities to go out and get a job. There's not always opportunities to get a good job. In fact, there's not even opportunities sometimes to get any job that's decent. There's not always opportunities to find a raise. There's not always opportunities for your boss to give you, more for less. And yet in the stock market, the opportunity exists. So that's something that's really important to understand in this cash flow segment, is if we learn these techniques, we will always have something to work on. We'll always have somewhere to turn. We'll never be without opportunity, which a lot of E-quadrant people, meaning people who are employees, sometimes they get laid off and they don't have opportunity right now. So this is beautiful. Upward movement is something most of us are familiar with. You buy a stock and it goes up, so that's pretty easy. Downward movement is something most people are familiar with but have not ever done themselves, which is a shame, because that takes away a huge part of this opportunity. If you don't learn all three, then there isn't always opportunity. There's only opportunity always if you know all three. My favorite one is this one right here, baby. Now, I'm not supposed to be biased, and I'm not supposed to recommend things to you, so I won't. I will say that that's my favorite, because I have freedom of speech. I can say that. But I think a person needs to learn all three. So let's start with upward movement. That's going long. Now let's be sticklers, shall we? Nothing like being a stickler right out of the gate. Let's do vocabulary. See this word long right here? Long does not equal bullish. Now, even though we're associating it with upward movement, I want you to learn this the right way out of the gate. What long means, what long equals, is that you're going to buy something and you're going to own it. That doesn't necessarily equate always to upward movement. In other words, there are things I can buy that I bought and that I own that will benefit me in downward movement. I'm just saying, if you're going to buy stock, you want an upward movement. Quick illustration so you know what I'm talking about, and why I'm being a stickler is I might say to you, hey, I'm long the VIX. Okay, well, that means I'm actually bearish the market if I'm long the VIX. You want to see? Let's just do one. We'll do this again in risk management, where we just as well get it right here, right now, just well do it the right way. Check this out. Let's go to this one. Okay, this is the VIX. If we look at the market, do I have the market up here? Let's do the market. Let's bring up the let's just bring up the S&P 500, I guess. We can start with that. If we bring up the S&P 500, it's had some struggles this month as of late, especially in early August. Okay, today August, getting close to the end of August, a little spinning top here on light volume. Looks like people don't know what to do now. But this big landslide here. So I was bearish during this time. So I wasn't short, I was long. Check this out. I was long the VIX. Let's get rid of this. I was long the VIX. See how this is going up? So I was long the VIX in this period right here. See this period right here? That's where you want to be long. So even though I was bearish, I was long. So that's why, the big, stickler on what long means. It means you buy something and you own it. Separate now. Separate in your mind now the term bullish from long. That'd be the best thing to do, and then you'll never screw it up and you'll be okay. Okay, I like it. So if you're going to go long, how do you do it the right way? How do you buy stock the right way? Well, let's start with basic stuff. Here's one thing, one technique you could use that help you. Have you ever had people that you're talking to them about your stock or whatever, and they say, hey, I don't know what to do. I bought some Hewlett Packard and went down, and now I don't know whether to buy it or sell it or buy more or get rid of it. Or, I'm scared that if I get rid of it, it's just going to go right back up the moment I sell it. And I'm scared if I hang on to it, it's going to go down further, cost me even more money than it has. I don't know what to do. And that's amateur investing, isn't it? Where you don't know what to do and you're struggling. So here's a way that you will never be in that situation ever again. If you'll do these 5 things that we're going to talk about when you buy stock and when you go long for a little capital gain here, you'll never be in a situation where you don't know what to do. Does that sound appealing? Sound like something you could commit to? Sounds like something you want to share with your fiduciaries? I think it is. I think it's wise. So let's see what you think here. 5 things we're going to do. Now, a little technical analysis. What do we got here? We have an uptrend. Right, this high here is higher than this high, and this low here is higher than this low. So I draw my trend lines, just like we learned, and I see it's in a range. I also remember from the technical analysis class that this was a point of resistance, and then boom, they changed their mind, and it became a point of support. And that's not going to happen dozens of times, it happens thousands of times. So in my mind's eye, I say within myself, I think that it's likely to just do that. Okay, and that's what I think. So I want to exploit that. Okay, so I'm going to do 5 things to try to earn this money and exploit this move. Okay, here's the 5 things we're going to do. Number 1, we're going to put in our entry here, off support, maybe bouncing off support, maybe a little above to get put in, make sure this is established. We're putting it here around $100 somewhere. Whenever I say the word entry, I want you to speak out loud with me, even if you're in your home, even if you're going to wake someone up, even if it's at night or in the day or whenever it is you are. I want you to say entry criteria. Entry is associated with criteria. It's not a gut feeling. It's not even a feeling it will go up. It's Mr. Spock. It's the casino. It's the rules. For example, I might set a rule that says, if I'm going to be long in a stock, I'm going to buy stock, the broad market has to be bullish. That might be a rule. I might want sector rotation, meaning that money's rotating into the sector and it's showing strength. I want to be in one of the stronger sectors. That's a rule. I want to have fundamental analysis on that corporation that has earnings, it has a good PE, it's got good value to it, the peg is stronger than others in its group. I just want strong fundamentals or I'm not trading the stock. I want to have some technical indicators, maybe a MACD or stochastic or relative strength index. I want some type of technical indicator saying this is heading the right way. I want price patterns that are bullish. For example, I want higher swing highs and higher swing lows. So I want a trend within the stock that matches this broad market that's bullish. Maybe I have a candle pattern. Maybe this thing's coming down here and I've got a little trough here and got a little candle here, and then I see a bullish engulfing candle maybe. Some type of candle pattern that is bullish right here. And then I want a good reward for the risk I take, good risk reward ratio. Okay, that's a short list, and as you get more classes that are more advanced, you can add to that and lock it down. What's the message at the basic level? What's the message right now? Criteria. We got to have some type of criteria, not gut feeling. Now, contrast that to your 401k stuff. I know I'm always bashing them, but hey, I wrote the book 401k Chaos. What else am I supposed to do? That's what I do. But look at this. You buy a mutual fund. Why? QE3 or no QE3, you're just buying it. Sovereign fundamentals, to heck with Europe. We're buying it. Stock market, S&P downgrade, we're buying it. They buy no matter what. Buy. So mutual fund companies can charge fees. I don't know if that's why they say do it. Could be, but it's certainly not criteria. Certainly not as good as we can. We can do better, can't we? We can. So there's my little vent on that. Okay, I'll try to get under control. Target's got to be likely. Now, it'd be silly to set a target on this, at 180, okay? Look at its trend. It's going at about this pace. This is about the angle it's going at. 120, hey, that seems pretty likely to me, right? I don't want my goals being hopeful. I want them to be what? Likely. Remember that? I want the goals to be likely. And so, it could go down, it could shoot up, but this is probably, our likely scenario, unless it changes, which it may. But all things being the same, object in motion stays in motion until something changes it. So we're going to say, hey, we're going to go for this target right here. Now, likely, criteria, entry, target's got to be likely. Why would I trade something that's not likely? I don't know why I would. Don't think you would either. Now it's time for a lesson to reprogram our brain and allow ourselves to at least open up the idea to something new. Some people say you're supposed to buy a stock and hold it till you die. Okay? What if you did that with some of your other assets? I want to do what I expect. You're a businessman. This guy's sleeping on the job. What control do you have over that? If the guy isn't doing what you want to do, what control do you have? The only control you really have is what? Terminate him, send him home, disciplinary action, right? Something negative. But you can't just sit around and say, well, gee, I hope this changes. Maybe if I just wait long enough, he'll start to work hard. No, that's no control. What measures do you have to impact this guy? Terminate him, fire him. You owe it to your shareholders and your family and to him. Okay? Real estate guy gets the final notice on his rent that's past due and he doesn't pay it. What control do you have? The only control you have there is to say, hey, look, we're gonna have to evict you. You've left me no choice. I got a mortgage to pay on this thing. You're not paying the rent. Can't do it out of my pocket. Can't let you live for free. Doesn't work that way. So you understand that when things don't go your way, you have to look at what controls you have. What controls do you have? You can't make the guy work harder. And so if you can't make him smarter or make him work harder, you're going to have to let him go. You can't make the guy pay his rent other than what? Okay, make me pay. All right, then the only control I have to make you pay is what? I got to evict you. Well, gosh darn it, if a stock goes down, what control do you have if your stock doesn't perform the way you want it? The only one I know of is hedge or sell. That's it. It's the only two I know. Either sell the thing or you hedge, one or the other, either insurance or sell. So you got to think, what control do you have? If you want a cash flow, you want a capital gain, you want this to go, you've got to act on it. Okay, got to act on it. So an exit. When do you put that in? Before. So write this down somewhere if you're writing stuff down. If you're just listening the first time, I know you'll listen again and write it down the next time. Trading journal. In a trading journal, we write these 5 things down, and here's the key word: before. This is how you avoid being, the guy in Hewlett-Packard that doesn't know whether to buy or sell, because you've got this whole thing planned now, don't you? You got the whole trade planned before you get in, and no matter which direction it goes now, you've got a plan of what you're going to do before. You'll never be in a situation where you don't know what to do. Sounds pretty smart to me. Pretty tough to lose half your money in this stock if you're doing it this way. You got to have your reward down. That's just the distance between the entry and the target that's likely. So here you're looking to make 20 bucks. You know what? If you're going to go to the office and someone's going to hire you, one of the things you probably ought to know is how much money you're likely to make. Can you imagine that in a job interview? Come work for us. Oh, really? How much are you going to make? I don't know. Something. Well, do you have any idea? Not really. Don't you think we should have an idea of what we're going to make? How much are you going to make in your 401k next year? What's your target? What's likely? How much are you going to make in your 401k? How much are you going to make in your IRA next year? 30,000, 100,000, 100,000, $1? What you going to make? We want to have an idea of what reward is likely and what that number is, so we have something to shoot for. So we're not just ambiguously nuts. Got to know our risk. A lot of people just buy that at 100, let the thing. Lucent Technology goes from $70 to zero. Look at WorldCom. Enron goes from $90 to zero. I got to have a line in the sand, man. I got to decide what am I, and I don't know that I'm going to risk $100 to make 20. I'd risk $10 to make 20 though. That's the distance between the entry and exit. There's 5 things. Put those in. Try them out. Experiment on paper and talk to your fiduciaries. Does this make sense? Let him poke holes in it. Maybe you want a different fiduciary. I don't know. Let's see what happens here, though, okay? So you got your target and your entry. Now, look. This is called a risk-reward ratio. Notice something here. Let's get the pen out. Notice here I had $1 risk and I had $2 of reward, didn't I? For every $1 risk I was willing to take, I had 2, and it's nice to have 2 or more, I think. So you make 10 trades. Whoops. So you make 10 trades. What am I doing here? So you make 10 trades. Push the wrong button sometimes. And 5 of them you're right and 5 of them you're wrong. Well, on the 5 of them you're right, you made $20. That'd be $100 you made. On the 5 of them you were wrong, you lost 10. That'd be 50, but you made 100, lost 50. I like that math. And that's when you're 50-50 on your trades. You're going to find out, and in fact, I bet you'll notice as you get past awareness into competency, and then once you're into proficiency, it's not that you're some genius stock picker. Look, you're using criteria, you're using the fundamentals, you're using the technicals, but it's this idea of exit, right? It's this idea of exit that you're going to be using that's going to help you trade. So when we want to make money in an upward market, and the fundamentals and the technicals say yes, this is upward, it's more likely to go up than down. We have really good, and that doesn't make sense too, doesn't it? If we got an upward market in the beginning, the sector's strong, we got this good PE, we got this good PEG, we're getting a good value, it should go up. It should naturally continue in its trend. We can feel confident with that. Some weird anomaly, great. We trade 10 times, do this 5, that's cool, we can live with that. We're making money, right? We're doing all right. So that is risk to reward ratio. So before we finish this little, before we move on to going short, 5 things we got to have: target, entry, exit, risk reward. Back to, and if I cover, and see, I know you've got these memorized, right? We'll cover them all up, okay? I know you can get them without peeking. We always need to have what when we enter stock? We got to have what? Criteria, don't we? And if we're going to set a target, it can't be clear up here. It's got to be something that's what? Something that's right in the old range there. Something that's likely. Hey, if it goes where we don't want it to go, we got to exit. When do we plan that out? Before. So, likely, criteria, before. We enter based on criteria, not emotion. Is it up to snuff? Does it fit all the stuff? Does it fit your fundamental and technical stuff? I'll tell you what, you get in the next classes in competency, we start getting real detailed on that baby when we have time. Likely target, got to put this in before. How about a trading journal? How about you list these 5 things in that trading journal? List your criteria, list your exit. Why do you think it's likely? Draw on some charts. They're fun to draw and see. You just connect the dots like that. There's your trend, right? So you might say in your trading journal, okay, Andy, I'll tell you why I bought this stock. I bought the stock simply because resistance was turning in support. I had higher highs and higher lows. I was in an uptrend. I had a PE that was really, really low, and I had a PEG that was even lower, and it was beating the others in its industry group, and the broad market was up, and there was sector rotation going in. That's a lot better than saying, Andy, I bought this mutual fund because I was told to. I like that better. So, risk reward ratio, give you a little numbers in your advantage. We'll talk more about that in risk management. But now that we know how to do it a little bit better when we're going up, let's talk about how we make money when it's going down. That might be a little bit bigger discussion because some people have never done it. Let's talk about it. What if things start going down? Like maybe the US dollar has been headed down, stuff like that. In fact, in technical analysis, we saw this right here, and just a little review right here. That looks like a shoulder to me, and this looks like a big head, and that looks like a shoulder. You know what that looks like? That looks like a white pen that doesn't show up very well. That looks like a green pen that shows a really nice shoulder and a really nice head and shoulders. And if I draw a line straight across the bottom of that baby, the support becomes what? Resistance, and that's called a kiss goodbye. And this right here is called a double top, and I draw a line at the M, and sure enough that hits that and bounces down way down here. And look at this, how this support became what? Resistance right here. And that's what you call a descending triangle. Not when I don't draw it well, though. You don't call it that. Let's try that again. That is what I call a descending triangle. So interesting stuff, man. In fact, that's going to come, and we'll see if it just breaks down further. We'll see what happens. But that's how that works. Now, so what if we do our technical analysis, our sovereign fundamentals say this thing's tanking, how do we exploit this? Well, we short. Now, I was a big stickler on long means we bought it, we own it. Short means that we're going to borrow something, we're going to sell it. And that just makes, you're going to have an advantage here because most people's brains melt down. Yours isn't melting down, and mine's not melting down. We might not, I mean, I'm not the smartest guy in the world, and I'm sure you're smarter than me, but you're going to catch this. The problem is because it's abstract, people's brains don't want to accept it. And it's not that abstract after you get done with this example. So this is not Grand Theft Auto where you're selling stuff that doesn't belong to you in a bad way. You're going to borrow some stuff and sell it. And this is actually really cool. Think about this. Have you ever borrowed a cup of sugar and returned it? Have you ever borrowed someone's car and returned it? Have you ever borrowed anything, someone's pen? Hey, can I borrow your pen? Right, and returned it. And so all you're going to do is something you've done thousands of times in your life. You're going to borrow something from someone, and then you're going to return it. That's it. And you're not going to break any rules, okay? You've borrowed movies from your names. I know you borrowed that Barry Manilow album from your buddy. Did you give it back to him? I know you've got it. You love the Barry. He writes the songs. he writes the song that makes the young girls cry. Isn't that sad that I know that? That's frightening. Okay, I know you got that Neil Sedaka album you borrowed. Okay, so we're going to borrow some stuff. Here we go. We're going to borrow some things. Downward movement. We're going to exploit this. Hey, on a serious note, the only time there's always an opportunity is if you know all three, up, down. This is exciting because if you make a commitment to learn this and understand it, you have a whole new world now opening up to you, whole new opportunity. Why am I selling this so hard? I'll tell you why I'm selling you on this concept right now. Look at the sovereign fundamentals. Okay? Everything that happens is in the shadow of those sovereign fundamentals we talked about. Greece is in trouble. Okay? Europe is in trouble. United States downgrade. There is reason to justify getting good at shorting, even past awareness now, right? So relax. If you don't get it the first time, what do? You review it. Just like that car you were driving with the clutch, stick shift, you stalled it a few times, but once you kept trying, you got it down. Now, I've taught this to thousands of people, and I used to teach it with stock. It never worked very well, so I teach it with something else. You've borrowed a cup of sugar. You ever borrowed someone's phone to make a call? You ever done that? Say, hey, can I borrow your phone? Make a quick call, text somebody, whatever. My phone's dead. My phone's always dead, man. My battery's dead. So let's do it with a phone. Now, the first thing I'm going to ask about this phone is this. I'm going to say, what's likely? Technology, I mean, here you got the iPhone 4, let's say, and the iPhone 5 is coming out. When the iPhone 5 comes out, you think that's going to go up in value, or do you think it go down? I mean, sure, maybe it could go up, but what's more likely? I would say that if I were a betting man, and since I'm a stock trader, I'm a betting man, I'm going to say I think it's going to go down. I think that when the iPhone 5 comes out, that the iPhone 4 is not going to be worth as much. It's called obsolescence risk is what it's called. And so we think this thing's headed downward, okay? So what do? You go to your boss. You say, hey, man, my battery's dead. Can I borrow your phone? Or, hey, I need to go to Europe. You have the AT&T on roaming on this business trip. I'm taking your phone. Whatever it is, you borrow it. Now, this isn't devious or mean. You're just borrowing his phone. And when you give it back to him, it's going to be in the same condition that it is today. Everything's on the up and up here. You're just borrowing his phone. Say, hey, boss, can I borrow your phone? Yeah, you can borrow my phone. Go make your calls. And you think this is going to go down. Now, here's the thing. The New York Stock Exchange, the NASDAQ, just an auction like we talked about in technical analysis. Remember that market maker? He's looking at buyers and sellers. Do you know that's all eBay is? All eBay is a place you can go and sell stuff, find out what the supply and demand is. You want to find out something's worth, what something is worth, look it up on eBay, and you find that phone's worth $500 on eBay. You think it's going down in value, so you sell it. Now that does sound weird. You wouldn't do that in real life. You wouldn't sell your boss's phone, but you're going to find we're allowed to do that with stock. It's 100% legal, ethical, moral, right, true, good, and everything else. But just get the concept now. So we're going to borrow your boss's phone, and we're going to sell this on eBay for 500 bucks. Now, what do you owe your boss? You don't owe him any money. You owe him his phone back. So you're going to have to give him back a phone here in a little bit. We're going to see if that's likely and that's going to do. We said that we thought this was going down, right? We think this is going to go right down here in value. And so we're going to wait for that to happen. And sure enough, we let that price drop just as we had prognosticated. Now the iPhone 5 comes out, and now that phone's only worth 300 bucks. But you have $500 because you sold it when it was up here. Very cool. Guess I'll bet you already know what you're going to do. See, 3 steps and you already got it. You borrow it, you sell it, and you let the price drop. I'll bet you got the rest of it. What do you owe your boss? You owe him a phone. What are you going to have to do? Buy it back. But you only had to buy it back for the new price, $300. Now give him back his phone and show him you're a good guy. But what you got? You got 200 bucks left over. Let's review that. Holy cow. We thought the phone was going to go down in value. Obsolescence risk, right? The iPhone 5 comes out. Bam. It's going to go down. So we borrow somebody's phone. We sell it on eBay at the high price. Sure enough, we let the price drop, buy it back, and we keep the difference. We give them back the phone. So that's how shorting works. You simply borrow something and sell it off when it's expensive, and then you buy it back when it's cheap and return the item. Now that seems kind of weird because, you know, the phone lost value and all that, and, you know, you wouldn't do that with your boss, but understand the concept now. You know, that's how stock works. So we look at a stock and we ask the same question. What's likely with this stock, right? Maybe it's the UUP, right? Maybe it's that exchange trade fund we think is going to tank, or whatever it is. Maybe it's Fannie and Freddie. Maybe it's Blockbuster Video. How do we know what it's likely? Fundamental analysis, technical analysis. We see they have no cash flow. We see their debt climbing up there. We see obsolescence risk. We see market share being taken away from Blockbuster by Netflix. We say this stock's had its run. It's headed down. Going on down, baby. Down, down, down. We think that sucker is going down. Why do I always choose the green pen? Red is a better pen for going down. So what do? We say, hey, Mr. Broker, can I borrow some stock? Can you do that? Yes, you can. Is there interest on it? Yeah, but it's negligible at this point for this discussion. It's like tiny, tiny, tiny. It's not like your credit card loan. It's tiny. It's what we call negligible in many instances because we're not holding it for very long. And so we say, can I borrow the stock? Hey, if you put money in the bank, they're going to loan that money out. The bank will loan money out. They have fractional reserve lending. They're good with it. Fed lets them do it. Well, look at this. We can borrow stock too. You can borrow money. You can borrow stock. You can borrow a cup of sugar. You can borrow his favorite tie. Whatever you want to borrow, your broker will loan it to you. So you're going to borrow some stock. What do you owe him? 1 share. Why did you borrow it? Because you think it's going down in value. And so you sell it on the New York Stock Exchange. In fact, you know what's crazy? The broker will even do both those steps for you. He'll not only loan you stock, he'll actually go find a buyer for you and sell it. Go to the market maker because he stands ready to provide liquidity, remember? So we borrow. So I'm getting too fancy. Look, you borrow the stock. You sell the stock for 500 bucks. What do you do next? You let the stock drop to 300. You buy it back for 300, and the brokerage takes their stock back when you say. Is that awesome? No time limit either. Just got to make sure you got your margin requirement. What's the danger of this? What's the danger of this? That sounds too slick. The danger is what if the thing goes up? Let's draw this graph up here. And what if the stock goes up to 600? Well, if the broker wants his stock back, if you sold it at 5 right here and he wants a stock back, you're going to have to buy it at 6, which be what? Buying high and selling low. If you buy something at 600 and you sell it at 500, you just lost 100 bucks. And the reason a lot of people don't short is how high can this go? Well, it can go further than this screen because you know what's north of that? This crazy number, infinity. Is the stock going to hit infinity? No. There's no such thing as stocks that hit infinity, but in theory, that's your risk. And so what do we want to do? What do we want to do when we do this? I'll tell you what I would do. I would set, watch this, I'll even do it color coded. I would set an entry here at 500 bucks. I would set a target here at 300 bucks. And I would set a what? What was the other one we did? We set an exit here at maybe 550. And that way, if the stock goes down, let's get a pen here. If the stock goes down, we make our money. But if the stock goes up, we exit. We only lose a little. See, it works both ways. So very, very cool stuff. We still have an entry, a target, exit, and risk reward here. So review one more time. We borrow the stock because we think it's going where? Down. We sell it on the New York Stock Exchange, right? Okay, sell it on the New York Stock Exchange. We let the price drop. We buy it back. We keep the profit. Give back the stock. We're all square. We could do it again. That's the shorting concept. If you didn't get it, back it up and do both examples again. We think it's going down. We borrow it. We sell it. We let the price drop. We buy it back and give them the item back. Same thing. We think it's going down. We borrow the stock. We sell it. We let the price drop. We buy it back and keep the money. How simple is that? You do it enough times, you'll get it. One more? No, I don't think you need it. So this is what's really fries people's brain when they realize this. Watch this. This is going long in the stock, right? And this is going short in the stock. And if you'll notice, these are identical. Sold at 40, bought at 20, profit at 20 bucks. Sold at 40, bought at 20, profit at 20 bucks. See that? The only difference is the order in which we do this. Here we bought first and we sold second. See that there? And here what did we do? We sell first and we buy it second. And how are we able to sell something that we don't own? We borrow it. We borrow it and sell it, buy it back and return it. Isn't that cool? I think that's cool. What's not cool is when I don't run this right. Why do you think I do that? Because you'll notice there's a consistency. Whenever I do this little faux right here, it's because I'm trying to erase ink off of the screen. The buttons are right next to each other, and I have hands that are big as, my fingers are like sausages. They're massive, like big basketball hands. So watch this. When I buy a stock, let's get the colors right. When I buy a stock, there's my entry. Right? Maybe my target is like right up here, but what would I have to have just to make sure we're safe here? I'm going to put an exit, and that way if the stock goes the wrong direction, I don't lose as much, right? Okay, if I'm going to go short, I'm going to do the same thing, right? I'm going to enter here, but now my target is for it to go down, isn't it? So I'm going to put my target down here, and what am I going to do? I'm going to put an exit up here. That way if it goes up, I don't lose a lot. So again, the only difference is here I'm buying first and selling second, and here I'm selling first and buying second. That's it. In fact, a good story to tell right now is the key in the engine. Do you need to know how the fuel injector works to make this happen? Nope. Do you need to know how the key works to make this happen? Yep. To drive a car, you need the key, not the engine. So when you short stock, or when you go to buy or sell stock, what you're going to see is this. Let's draw some white buttons. Over here you'll see a button that says buy and a button that says sell. So we'll put a B in this. You see a buy button and a sell button. And if you think you want to go long, you buy it first. Remember, buy long means we buy it and we own it. Short means we borrow it and we sell it. Okay, if you want to do this one, there'll be a button that says short or sell short. And there'll be a button that says either buy, or usually it says buy to what? To cover. B to C, buy to cover. Because you're covering something you borrowed, right? You got to buy it back so you can cover what you borrowed. Very cool stuff. Very cool stuff. I want to reiterate, I know I go over it, but a lot of people are new when I teach it, and I don't know if you are. So right here, notice this and this is the same thing. We're buying low and selling high. We're buying low and selling high. It's just here we bought first and sold second. And here we sold first and bought second. Did I belabor that enough? I hope I did, but I hope you know I'm just trying to be sensitive to people that are new to the program. Same points to identify as I illustrated, right? In the entry, I'm going to say, here's my entry here, boink, and here's my target here, bam, and here's my exit here when I go long. That way, whoops, that way, if the stock goes against me, I can't lose very much. Because down here, the most I can lose is 0, and the highest it can go is what? Infinity. Over here, the highest it can go is infinity, and the lowest it can go is 0. So if I buy a stock, and there's no exit in here, I can lose what? I can lose 100% of the money I put in, because I buy right here, stock goes down to zero, go bankrupt, use 100% of your money. Okay, you buy right here, they cure the cancer, it goes to the roof. So here you have a risk of infinity, and here you have a risk of 100. Well, before I get this too ugly, if you lose 100% of your money in a stock, that's dumb, because we could have put in a what? An exit. If it hits here, most of them loses 10 bucks. And if you lose an infinite amount of money, which doesn't hurt any more than this, if you lose all your money, losing an infinite amount is the same feeling. Thank you. And this scares everybody. Ooh, infinite risk. Stocks actually don't ever hit infinity, but this could double, you know, and if it doubles, that's not good. It could triple, it could quadruple, that's realistic. Okay, so what do we want to do? We don't want to lose 100% of our money, so we put in a exit. We don't want to lose an infinite amount of money, so we put in a exit. I think you got it. So that's going long, and that's going short, and that's the 5 points we put in when we're going to go stock. This is a good basic class. This is a good basic to get started with. In your advanced class, we're going to learn even more. Think of how good you're going to be, though. I mean, pretty soon you'll be saying, oh yeah, and there's a doji right here, and oh yeah, and it just broke above a moving average, and oh look, the MACD just crossed, and all kinds of cool stuff you're going to see. You just get better and better and better. So yeah, you will get better and better and better. Another thing we can do is we can talk about when we hit targets. So let's say this stock does go up, and bingo, it hits the target. Some people say, oh, I'm going to sell it. I hit the... No. What if it does go further? Why? Here's a question. Why would I take away my upside? If I hit this target of 120, yeah, I made 20 bucks, but hey, we might make 10 more. In fact, we make $40. Why take away upside? Just as this thing can break down, it can also break out, right? Just as it could possibly break down. It's not likely to break down. It's not likely to break out, but either of them can happen. So if it hits here and this breaks out, my word. So what people will often do is they'll adjust the exit. In other words, over here, when it broke out, we just move our exit up here. That way, if it keeps going, ooh, we're in for it. And if it pulls back, bam, now we're out. So we kind of let the stock put us in and take us out. Let me give you another hint right here. Sometimes what I'll do is I'll put my entry here. I said we could use the computer and then we wouldn't have to babysit this. Maybe I put my entry here and I tell the computer, look, if it hits 102, I know that's not to scale, but if it hits 102, that means it has to be headed what? The right direction to get in, right? So this gets established. What do you think the chances of that hitting the target are once this turns the corner? Do you think it's better or worse? Because you think about this, right now it's headed down, isn't it? Right now it's headed down. So what I'm going to do is I'm going to say, hey, put my entry in just above. That way it's got to be headed where? Up. If it hits it, we're making money during the day. If it goes down, we were never in the trade. If it goes sideways, we were never in the trade. Kind of a cool trick. Well, we're going to do the same thing over here. We're going to say, look, this thing shot up to 125. I'll put my exit at 120. And maybe it shoots up to 130 or something like this. I put my exit here. And then maybe it shoots up here and I put my exit here. Then maybe it shoots here and I put my exit here, and there's a double top, and boom, right there is where I get stopped out. Very cool stuff. So that's adjusting the exit, and great things to learn. I'm going to put you in an advanced course after this one that's going to get way detailed on this, but right now we're just getting some basic concepts down. I hope you like them. You know, ask yourself this question. If you simply do these entry, target, exit, here's my risk, and here's my reward, right? You do those 5, what a difference that would make right there. I think it would make a pretty big difference. Why don't brokers just do this? Well, as I said before, that's always a good question. Why don't they? Well, imagine trying to do what we just did for 1,000 different clients at 1,000 different ages, at 1,000 different incomes, at 1,000 different tolerance of risk, 1,000 different goals, and each one of them has 10 stocks. That's 10,000 stocks to have to put in what? A entry, a target, an exit, a risk, and a reward on. That'd be tough, wouldn't it? I don't even know what that means. I'll bet you know what it means. So, yeah, brokers are great, guys. Don't get them wrong. It's just really hard. No one cares more about your money than you, right? No one cares more about it than you. Now we have to figure out how we can do this faster and better. So that's long and short, but is there more? Oh, yes. Oh, yes, there's much more.